We just moved from Henderson, Nevada to Franklin, Indiana. Moving is expensive.
Did you have any unexpected moving expenses?
We had some expected, unexpected expenses.
And we prepared for those expected, unexpected expenses because we've moved across country multiple times. This is our fifth major move, not just a cross-town move. We knew that there would be those expected, unexpected expenses. And so beforehand, we went and took a loan from our life insurance policy to be a cash cushion for us.
No, wait, just a second. We're talking a foreign language to most people here. A policy loan from our life insurance. How does that work, John?
Well, policy loans can be taken once you've built up enough equity in a life insurance policy. And we're going to talk about that later. But let's talk about how we've used this cash cushion. You know, we took this policy loan. We were able to access money without having to go through a bank underwriting process. We put that money in the bank account, and we were able to sit on that cash cushion. Not literally, like on our couch, but sit on it in a bank account. And that came in really handy.
Okay, I'm playing devil's advocate today. You used another big word, equity. What in the world is equity?
Well, you know, if you buy a house and you pay a mortgage payment, you're going to build equity. That's like your ownership in the house that you buy. If you buy the right type of life insurance, the right type of life insurance will build equity. And that's like the equity that we were able to use as our cash cushion during this latest move.
And that cash cushion gave us comfort.
It did.
Because we knew that there would be these expected, unexpected expenses. And so that cushion just made us a little bit more comfortable knowing that we had the funds to quickly meet those expenses.
One of these unexpected expenses that we had prepared for was tires. And you didn't want to have any tire troubles on the way. And so you went around, you looked at the vehicles, you inspected the tires, treads were in good condition, plenty of it left. You even replaced 2 of the tires on a trailer because you wanted to make sure that trailer would be reliable on the road.
Well, you know,
2
we had
tires
11
before the
vehicles
trip.
on the road, John.
Yeah.
We had 11 vehicles and 3 trailers. And one of those vehicles had dual wheels on the back. So we had a lot of tires on the ground. A lot of tires, and we didn't want to have any unexpected incidences with those. But in the back of my mind, having moved many times before, I knew there probably was going to be some issue that we needed that cash cushion for.
And there sure was. Part of it may have been our route because we took Highway 93 from Nevada down through Arizona, lots of potholes on the road, and then we hit Interstate 40 going through Arizona and New Mexico. For those of you who have ever driven that stretch of road, you know what it's like. For those of you who have never driven that stretch of road, you might not want to find out.
You need a cash cushion.
Especially if you have a trailer that's heavily loaded. Those trailer tires going through the potholes, it wasn't long into Arizona that we had the first blowout.
And blowouts change your whole schedule because now you got to find a tire store that's close.
Yeah.
You know, part of our party went on ahead because we didn't want to lose our reservations where we're going to sleep every night. And the rest of us just hung back. And, you know, sometimes it was 4 or 5 hours before we got tires back on the vehicles and, you know, taking spares off and putting it back on and then rotating that. I mean, we changed a lot of tires.
Yeah, and it wouldn't have been an issue if we just had one because we had spare tires for all of these vehicles. But what ended up happening, you know, the first tire blew. Okay, we exchanged it with a spare, but then you got to replace the spare. So we did that next morning. Didn't delay us too bad. We had the jack in the trailer, you know, nice clockwork. But then when you start getting several tires go out, which we did, we ended up, because of those potholed roads through Arizona, New Mexico, we ended up having issues with 9 different tires on the road.
Well,
once we counted up afterward.
If I understand right, I wasn't with that particular party, but even putting on the spares, you got to looking at them and realize, oh, these are faulty spares.
One of the spares, was
something
an issue.
You couldn't even necessarily count on initially. So, and then, you know, Tom, you brought up another important point. It delayed part of the party with all the bad tires. And there was even one time where you realized to get to the destination that we had reserved hotel rooms at would really be pushing it dangerously for the safety of the party. And so you said, okay, we will get a different, you guys go ahead, go on. You have all those rooms reserved. That's okay. But we're going to get our own rooms in a different destination for the night. And we're okay for that with that.
Yeah.
Yes, we had already paid for the rooms, da 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 da. Little did we know that they were actually going to credit that back to us. That was nice, but still, we didn't have to fret about that because we had this cash cushion. So what? We didn't use that room. We need to spend more on other rooms. Better than an accident where we could have great loss.
And you might not be moving right now, but everybody needs a cash cushion. We never know when economic times are going to turn south like they are right now. Since 2020, the cost of everything has gone up by about 20%. That's the inflation that has hit our dollar. So something that cost $10 in 2020 now costs almost 12. And that has really bumped a lot of people's budgets out because they didn't have a cash cushion.
Yeah.
So then once we arrived at our destination, there were also some expenses that came up. We knew that the laundry room wasn't going to satisfy our needs. However, we didn't know how much of a remodel we would need to do on the laundry room, which included an entire remodel, new cabinets, new flooring, paint job, electricity, plumbing, all this stuff. And so
we didn't know until we got into the project how much would be needed.
Yes.
And I was really excited because our new place here in Franklin has geothermal, and that was going to save quite a bit of money on heating and cooling.
Sure.
But we get here and the geothermal's not working, even though the inspection report said it was working fine. Well, geothermals are expensive to repair.
They are.
We found out.
Yeah.
And that cash cushion, again, came in really handy.
Well, and during that time, there was a cold snap.
So-
Even the locals were saying, wow, this is a cold snap. And not having that geothermal, it was quite chilly in the house. So we were very grateful
Yeah,
for
and
that.
here's
cash
the way
cushion.
it works. For those of you who live in cold climates, you may already know this, but we were coming from Henderson. We didn't know how the geothermal typically works in a cold climate. They'll have the geothermal do the heating down to a certain temperature, and then if the geothermal isn't heating it fast enough, then it kicks over to in our case a propane furnace that heats it up a little bit faster. So that becomes the auxiliary, if you will. So that typically kicks off, I think, in our case, around 0 degrees. So in this case, when the geothermal was not working, it wasn't raising the temperature fast enough, and so the furnace was supposed to kick over to the propane generator or the propane furnace. Well, we found out we had a propane furnace that wasn't working either. And so that's why it got so cold, when the geothermal wasn't working.
Well, and then one final thing.
Now this is more than just a geothermal repair. It's a geothermal repair and a furnace repair.
So here's something that happened through all this, though, and this is a lesson that you can take home and put in your bank. The furnace man said your furnace will never act up when it's 60 to 70 degrees outside. It's only going to act up when it's freezing. And you don't need a cash cushion when everything's humming along really, really good.
Yeah.
It's only when things go south that you need that cash cushion.
Well,
So you have to prepare before you get there.
You don't think you need it, but the only way to have a cash cushion is to prepare for it when you're not needing it.
Absolutely. We've got to act as if, because it's not a matter of if, it's a matter of when. And we don't know the when.
That's
we just
right.
know that it's going to happen sometime.
That's right. And so, how do we get this cash cushion through life insurance? Well, the first step is you've got to put something in first. And so, how does that process work? If somebody doesn't have life insurance, they don't have a cash cushion, they want to build it, where do we go from here?
That's what we're going to talk about when we come back from the break.
This card game is fun to play and teaches character from the Bible. 52 poker grade playing cards represent hours of fun for years to come. Children, teens, and adults like this game because it is exciting and stimulating. This game is a great choice for family game night and a clever way to turn screen time into family time. Try to contain your excitement as you attempt to collect all of the characters in a suit before anyone else. You can order this card game by clicking on the link in the podcast description, or go to Amazon.com and search Wise Man, Foolish Man card game.
So, John, you were asking me, how do you build a cash cushion?
That's right.
And there's lots of different ways people can build a cash cushion. You can take money and put it in a tin can and bury it under your back porch if you want to. But then what happens is, we talked about that inflation factor. If you buried, $1,000 under your back porch in 2020, it's not worth what it was in 2020 now. So where do you park that money? Where do you store that money so that it's going to be worth at least what it was worth when you put it there?
How about a bond?
Yeah,
You
well,
do it in bonds.
some people will do it in bonds, but is a bond a good cash cushion? Not always, because it depends on what the bond market is doing.
Is it guaranteed? Is a bond guaranteed?
Well, if you hold it to maturity, but if you need a cash cushion, you may not be holding it to maturity if you need the money from it.
So like to access it.
To access it, no.
Okay.
It's not going to be guaranteed based on the time you might need to access it.
So you could actually lose money if you bought a bond and you needed to access that money because you're going to have to sell it at a discount, right?
Possibly.
So what about a CD?
A CD, you have a penalty because, again, the CD, the bank is buying bonds. And so they're going to guarantee a rate for a certain amount of time. And so if you buy a CD, and cash it out early, the bank's going to charge you a penalty on that.
So if somebody needed a cash cushion, you wouldn't necessarily recommend a CD for accessibility.
No.
What about equities?
Well, equities, you're dependent on the stock market for those.
What about a
What if
margin
the stock
loan?
market is down? Potentially, but then again, you're dependent on what the stock market is doing because a margin loan is limited, and if the market goes down, you might get a margin call.
So what about your house? You could invest in real estate.
Many people have done that, used a home equity line of credit as a line of credit that they could access when goings were tough. But then interest rates on those home equity lines of credit, those tend to fluctuate with the market. So that could be a downside. And, back in 2008, we saw home equity lines of credit, people would pay them down and the line of credit would be cut.
Well, not only that,
So-
John, is that a home equity line of credit is based on your ability to repay the loan, not really how the equity in your house is. So if I go to the bank and I want a loan, they're going to look at my income. And if I don't have enough income to say that I can repay that loan, they're not going to give it to me, regardless of what my home value is. This happened with a client of ours early on in our career. Her husband had a heart attack. And she thought, no problem, my house is paid off, I'll go get a loan. They didn't
Yeah.
have any way of repaying that loan because their income was so low. And guess what? They were denied.
Yeah, so that's like trying to open a home equity line of credit. Yeah, no go there. Some people would say, well, you should establish that before that crisis arises, and then they can't go back through underwriting again. Well, they can still cut the credit limit,
Absolutely.
and that's still an issue.
So that's
So
a
home
cash
equity-
that's a cash cushion for someone else, not you, by being, putting that all that money in one
Potentially.
spot.
Potentially. So how do you build this cash cushion? Some people use just a plain savings account, but then it's exposed to the inflation that you were talking about because savings accounts are paying still next to nothing, even as interest rates have been rising. You have a few high yield options out there, but again, you're fluctuating with interest rates.
Most of those
not
are
a
in
great
CDs
option for
too,
a cash
when
cushion
you're looking at
long
saving.
term. Yeah.
Okay, so cash cushion. Can you get it in an investment? Can you get it in bonds? Can you get it in CDs? Can you get it in a bank account? Can you get it in a house? Can you get it here or there? Can you get it anywhere? I'm feeling a little vibe like green eggs and ham. Yes, there is a place where we can get a cash cushion,
There is.
and that is in whole life insurance.
Dividend paying whole life insurance.
Yes.
Yeah.
Because when you pay your premiums, you pay off part of the death benefit, just like paying a mortgage. Every payment you make a little bit more toward the principal, and that means you own it. That's your equity. And whole life insurance, dividend paying whole life insurance, that equity is called cash value. And that cash value can be easily leveraged with a signature, not having to prove your firstborn or toss away your life savings or prove your income. It's just with a signature,
Yeah.
you can access that money. Now, when you access it, it's not your money that you access. And that's really crucial because we want that money to keep compounding for us and keep growing. And if we had to access that money and pull it out, then we'd lose the growth, just like in a savings account. We'd probably pay a tax penalty sometimes, just like if you accessed your 401k, or other things like that. So what we're doing is we're using the equity as collateral, and the insurance company then by contract has to loan us the money. Our money keeps compounding for us. Then when we pay the interest to the insurance company for the loan that they gave us, it increases their profits. And because it's dividend paying whole life insurance or participating, which is the same thing, we get to share in those profits that they are generating off of our loan.
Yeah, a lot of long words that you used in that. So let's break this down to somebody who's new to the life insurance space. Most people, you've probably heard of term insurance, but that doesn't build equity. You pay a premium, you get a death benefit for a certain amount of time. And if you live beyond that time, the premium's going to go up if you want to keep that same insurance policy. Most people don't keep the same insurance policy. They'll buy a new one at higher rates. And so that term insurance is a never-ending cycle, but at some point it does end for most people because they outlive the term insurance, and at some point it becomes more expensive than what they really want to pay to have the coverage. So term insurance has a place, especially for young families. It can provide good protection, but it's not permanent by any means. Then we have the dividend-paying, participating whole life insurance that you mentioned. That's a mouthful if you're new to that terminology, but basically a whole life insurance policy allows you to pay a premium, a set premium for life, and that builds equity that's also called cash value in the policy over time.
So you said builds equity, and it does build equity, but the listeners should also know that we also can fast track it so
Yes.
that we're infusing it with a lot of capital right at first, so they don't have to just wait for years and years. They'll have capital immediately.
Right.
So it's kind of like getting on the freeway. You accelerate really fast to get up to speed with the rest of the cars on the interstate or the freeway. But then once you get going, you don't need to keep the pedal to the metal.
Yeah, you got to
Otherwise,
back off.
You got to
a little.
back off. So, you can fund a life insurance policy like this dividend paying whole life insurance, with a fixed premium that's going to stay the same for the rest of your life. But then you can accelerate it by adding more. And that goes
It's
in.
better to do that.
It is,
Mhm.
because in that way, you can build equity in these type of life insurance policies quicker than you can in real estate.
So with these policies, then you get, when you pay those premiums, you get guaranteed values, guaranteed death benefit, guaranteed cash value, and you know that cash value will rise to meet the death benefit at the policy's maturity, which is usually at age 100 or age 121. It's a fixed point out there depending upon the product.
One of the nice things about this is that we don't have the federal government regulating this either real extensively like they do bank accounts and stocks and equities and bonds. They've got their nose in that. They got their nose in the 401ks and the IRAs because that's an exemption to the tax code. They don't have their nose under the tent so far with participating whole life insurance, because the state insurance commissioners are the ones that regulate that in the state that those contracts are sold in. So it gives us a little bit more freedom and a little bit more liberty, and that's why it becomes such a good cash cushion for us to be able to access.
That's right. Now, there's a part, we were talking about the whole life insurance side of this product, the dividend paying participating part now. This is above and beyond the guaranteed values that we were talking about. So the insurance company, when they make a profit, since it's a mutual company that we prefer to write these policies with, when they make a profit, they don't have stockholders that they're sharing that profit with.
Mutual meaning that the policyholders are the ones that own the company.
Policy owners are the ones that own the company. And so when the insurance company makes a profit, what do they do with the profit? They need to share it back with the policy owners. That comes back in the form of dividend. And a dividend in a mutual life insurance company is different than a dividend in a stock, just a run-of-the-mill stock company that's traded on any popular index, because dividends from a life insurance company are seen as a return of premium. And so it's tax deferred when it goes to buy more insurance in the life insurance policy. So when you have that add back into your policy and buy more death benefit, that's going to cause the death benefit and the cash values to rise even above the guaranteed values over a long period of time. This is one of the elements that helps to overcome inflation. So that way you're not just putting your money away in a savings account that's earning a pittance, but now, your money is actually growing over time, over the long-term picture. But you can still access it by taking a policy loan when you need to use it as a cash cushion.
Just the other day, I was looking at an illustration of a dividend-paying whole life insurance policy with a client. And when they pay their premium, which was about $4,500, their cash value in year 12 increased by $7,500.
That's cool.
That's a huge increase. You can't get that type of annual rate of return anywhere else that I know of. So if you put $4,500 into any account, investment, savings, CD, bonds, and you came back next year and there was $7,500 there, would you be happy with that kind of return?
Got to ask that question. Yeah. So now that we have used this cash cushion for a lot of expected, unexpected moving expenses, is it gone? Or how do we get it back again?
Well, if we spend that money on tires and laundry rooms and geothermal units and furnaces, and we don't consider the cost of our own capital, then it will be gone. And we will have to pay interest on that loan to the insurance company. Now, all's not lost at that point. There's no rush to pay it back because it's an interest-only loan. So we can just pay 5% of that to the insurance company every year and just keep that loan perpetually. But that may not be the best thing to do.
Right. We might want to make sure that that money's for us next time we decide to move. Next time
We're not thinking about that right now.
And next time we have some unexpected expenses, we want to restore that cash cushion so we can even set up a repayment schedule and we can choose however we want. The insurance company is not requiring any set payment on that principal. So we can set that payment. If we have an influx of cash, we could pay it all off or pay a chunk down.
Sure.
Or we could say, hey, let's plan on doing this every month. And we can even have the insurance company draft whatever amount we want on a regular monthly basis. And that will soon be restored.
So
Now,
Michelle,
Michelle,
you're saying you got to repay the policy loan if you want to build that back in the life insurance again. That's
Now, let's be serious.
But we
about
have
this,
flexibility
though.
with it.
We just didn't write checks off that cash cushion.
No.
We actually used a credit card that gives us points back because I want to earn 2, 3, 4% on that money while I'm using it. And the credit card gave us 30 days of free use of that money. So it placed all the tires. It helped buy the new washers and dryers that we need to put in our lawn. It paid for the new furnace. It paid for, the geothermal loop. And then when that bill came in just a few days ago, because we had that cash cushion, boom, we just write a check for it. And now we just got a cash discount of 3 or 4%.
All right. So
Well worth
people are asking us, so why'd you move from Henderson, Nevada to Franklin, Indiana? And we want to talk about that next time.
Yeah, I've sold a lot of houses, lived in a lot of houses. We bought a lot of houses in our lifetime. And that's just a story for another day.
Well, you're listening to Wealth Talks with the McPhees. We'll cover all of this next time.